Welcome back to The Explainer. Today we're diving into a candlestick pattern that's, well, it's designed to do one thing: capitalize on a lie. Seriously. It's all about spotting a market trap before it springs and flipping that deception into a really powerful trading opportunity for us.
All right, so here's what we've got on the agenda. First, we'll get a feel for the trap itself. Then we're going to dissect its anatomy, like candle by candle. After that, we'll check out the bull versus the bear setups, learn how to actually trade this thing, and wrap it all up with a look at the risks, rewards, and some must-know rules. Okay, let's kick things off with Section 1, the market's perfect trap. We're diving into a really common scenario that, well, you'll see. It's often not what it looks like at first glance.
And that right there, that's the exact question the Hikkake pattern was built to answer. It really forces you to stop and think, hey, is every single breakout I see the real deal?
And boom, here's the answer. It's called the Hikkake pattern. That's pronounced Hikkake. It was developed by Daniel L. Chesler, and it's built for one specific purpose: to spot these traps. The name itself is a dead giveaway. Hikkake is Japanese for to snare or to trap, and that's literally what it does. It finds a fake breakout and signals a potentially massive reversal. Okay, so now let's get into the nitty-gritty. We're going to break down the specific candle sequence that creates this signal. The anatomy of this trap is super precise. Every single candle has a job to do.
It all starts with the setup, which is basically a period of consolidation. You can see here how candle 2 forms completely inside the range of candle 1. This is what we call an inside bar. It's a classic sign that the market's kind of taking a breath, volatility is dropping, and nobody's really sure which way things are going to go next.
And then the trap is set. See that third candle? Price makes a move. It breaks out of that tight little range we just saw. And this is the bait. This is what lures in all those eager breakout traders who think, yes, I've got the beginning of the big move.
But then, the reversal. And it happens fast. The very next candle, candle number 4, just slams the door shut on that breakout. It snaps back hard in the opposite direction and closes, confirming the breakout was a fake out. And just like that, those early traders are officially trapped.
You know, what's so cool about this is the psychology behind why it's so powerful. Think about it. When that fourth candle reverses, what happens? It hits the stop-loss orders of every single trader who got trapped. And that sudden flood of forced selling, or buying, it's like pouring gasoline on a fire. It adds a ton of fuel to the reversal, making the move that much stronger and faster.
All right, so one of the great things about the Hikkake is that it's super versatile. It can signal a trap, whether the market's going up or down. So it's not just for catching falling prices. It works just as well for rising ones. Let's take a look at the two types side by side.
This table lays it all out pretty clearly. For a bullish Hikkake, the market fakes a move down, trapping the sellers before it reverses and shoots up. The bearish Hikkake, you guessed it, it's the exact opposite. It traps the eager buyers with a false breakout to the upside before it reverses and heads down. Knowing which is obviously super important for figuring out your entry.
Okay, so the big question: how do you actually trade this thing? I mean, spotting the pattern is great, but you need a solid plan to act on it. So let's walk through a simple 3-step strategy.
And listen, discipline here is everything. Rule number 1, be patient. You only enter the trade after that trap is confirmed. Got it? Okay. Rule number 2, your stop loss goes in a very specific place, just beyond the extreme point of that false breakout. That's your I was wrong point. And number 3, you need a clear profit target. Look for the nearest support or resistance. And always, always aim for a reward that's at least double your risk.
And this right here, this is the real beauty of the pattern. It's why traders love it. By its very nature, it's a low-risk, high-reward setup. Your stop loss is super tight, so your potential loss is small. But that reversal momentum we talked about, that can lead to a really significant gain. It's a great trade structure.
But let's be real for a second. No pattern is a silver bullet, right? Nothing works 100% of the time. So, to use the Hikkake effectively, we really have to understand its strengths, its weaknesses, and, most importantly, what we can do to improve its accuracy.
So let's start with the pros. First off, its rules are super clear and objective. There's not a lot of guesswork. Second, as we've seen, it's designed to capitalize on that momentum from trapped traders. Third, it just naturally offers great risk-to-reward ratios. And finally, it's universal. You can find this on Forex, stocks, crypto, you name it. Why? Because it's all based on human psychology, which is the same everywhere.
Okay, but what about the downsides? Well, for one, this pattern is kind of rare. Those strict rules mean you won't see it every day, so you gotta be patient. It also really needs some extra confirmation, like a spike in volume, to be trusted. And it's pretty much useless in sideways, choppy markets, where there's just no momentum to drive that reversal.
So, with that in mind, how can we stack the odds in our favor? Here are 3 essential tips.
Number 1, always confirm with volume. If you see a big spike in volume on that reversal candle, that's a huge sign of conviction. Number 2, go with the flow. Trade with the bigger trend, not against it. A bullish Hikkake in a larger uptrend, that's a much stronger signal. And finally, number 3, prioritize higher time frames. The signals you see on a 4-hour or a daily chart are just way more reliable because they filter out all that market noise you get on the lower time frames.
So there you have it. The Hikkake pattern literally transforms a failed breakout from something that could hurt you into a massive opportunity. The key takeaway here is simple, but it's really profound. When an expected move fails, that failure itself is often the biggest signal for where the true move is headed. So now that you know the trap, you can spot it before it springs.